This video is going to show you how to invest in very fast super growth stocks so that you can make above average long-term rates of return. This video is also going to give you the secret on how you can value them correctly. Hello everyone, this is Chuck Carnevale, co-founder of Fast Graphs, a.k.a. Mr. Valuation. In today's video, I am titling a primer on valuation, how to value and invest in very fast super stocks. This is part 3, by the way, of a 3-part series I've now completed, and I encourage you to look in to watch the other 2 videos. This video is going to deal with growth stocks and how to value them. First, it's important to point out that growth stocks are very, very different than ordinary stocks. Growth stocks need to be thought about differently because they possess powerful attributes that their more ordinary cousins do not. Even though this is true, the underlying principles of valuation will still apply even to growth stocks. Because just like any stock, a growth stock receives its value from the amount of cash flows it can generate on behalf of its stakeholders. Because of the high velocity of their earnings growth rates, true growth stocks will generate future streams of income that are multiples larger than those of the ordinary or average company. To illustrate that more clearly, I'm going to turn to the power of compounding and share a presentation utilizing the Rule of 72 that beautifully tells the story of compounding. But before I share the presentation, there is an urban legend that attributes Albert Einstein with saying that compound interest is the most powerful force in the universe. Now, whether Einstein actually said this or not is unknown, but the power of compounding is truly remarkable. Therefore, it should not surprise us that a genius like Albert Einstein might make such a statement. Personally, I was first introduced to the power of compounding by my economics professor in college. Later, this same man became my first and perhaps most important mentor and gave me actually my first job in the money management industry back in 1970. My professor created a napkin presentation that not only had a great impact on my impressionable young mind, but also crystallized for me the magic of compounding. I would like to share it with you here as follows. My professor would start by saying if you invest $20 a month or $240 a year over your average working life, which he defined as 36 years. By the way, this time frame makes the math work better. And if you earned 10% a year on your money doing that, you would accumulate approximately $80,000. Now, I do take a little bit of minor liberties with the math with this presentation. But then my professor would ask, what if you invested the same $20 a month over the exact same 36-year time frame, but instead of earning 10%, you earn 20% per year? How much would you then accumulate? Of course, intuitively, many of his students would answer $160,000 or double the $80,000 at twice the rate of return. However, astute viewers understand that because of the geometry of compounding, the actual answer is over 1.5 million, or more than 18 times as much money by earning 20% than you would have earned at 10%. Now, here's the logic behind the difference, utilizing, as I promised, the Rule of 72. As everyone in finance is aware, this rule of thumb works like this. Divide any return into the number 72, and the answer tells you how many years it takes you to double your money. Therefore, 10% into 72 means it takes 7.2 years to double your money. Now, on the other hand, 20% divided into 72 means it only takes 3.6 years, or half the time, to double your money. Since our defined working life is 36 years, if you double your money every 7.2 years by earning 10%, you will get 5 doubles over the 36 years. With these numbers in mind, and for illustration, let's track our first $1 of investment and double it 5 times, which means $1 goes to 2, 2 to 4, 4 to 8, 8 to 16, and finally 16 to $32. However, by doubling your return does not double your money. Instead, it doubles your doubles. So at a 20% rate of return, you'll get 10 doubles instead of 5. 36 years divided by 3.6 years equals 10. So carrying this logic out to its mathematical conclusion, add 5 doubles to your original dollar invested at 20% like this. 32 goes to 64, 64 goes to 128, 128 to 256, 256 to 1,024. So for perspective, the first dollar you invested grew into $1,024 by earning 20%, or 32 times as much if you only earned half the rate of 10%. Importantly, the same impact applies to every additional dollar that was invested. Herein really lies the true power of compounding, and herein lies the insight as to why a faster growing company is worth more than a slower growing company. If you had two companies where one grew 10% while the other grew at 20%, it's obvious then that the 20% grower would generate a significantly larger stream of future income of which you could discount back to the present value. In other words, its future value would be worth a whole lot more. Therefore, its present value would be worth more also, which means a higher current multiple can be applied as well. I would also add here at this point that what we're really talking about here is earnings yield, but instead of present earnings yield, it's future earnings yield with these high growth stocks to become important. However, because of the dynamics of these fast-growing companies are so extraordinary, they require their own special intrinsic value formula to capitalize those cash flows. This is what inspired Peter Lynch to apply his famous formula for growth stocks, which is the price equal to the growth rate, or often called the PEG formula. Later, when I view real-world examples with our fundamentals at a glance research tool, fast graphs, earnings and price will be graphed utilizing the PE equal to the growth rate formula. Additionally, I would like to point out that I discovered through trial and error that a PE ratio equal to growth formula for valuing a company begins to max out at a PE of 30. This does not mean that high growth stocks will never trade at a higher PE. Instead, this is just a caveat that anything over 30 times earnings should be thought of as a high valuation to pay for a stock, even a fast-growing one. One reason for this, and one caveat regarding growth stocks, is that it's very, very hard to achieve high levels of growth over extended periods of time. In very simple terms, competition will be attracted to the growth and not let you keep it all to yourself. At this point, a clear definition of what a growth stock is, at least in my opinion, is in order. For me, to consider a company a true growth stock, the company must possess at least a 5-year history of extraordinary growth in its underlying business. My minimum threshold will be a rate of change of earnings growth of 15% or better. So this is where the PEG ratio formula works. However, as you're going to see with some of these companies I examine, they will have achieved earning growth rates far in advance of my minimum threshold. It's important for you to understand that my focus here is on business growth, not price action. Therefore, I'm not forecasting where the stock price may or may not go. Instead, I'm endeavoring to determine the true worth or value of the business itself based on the amount of cash flow it's capable of generating for its shareholders. The following examples represent an eclectic compilation of growth stocks based on my definition of a growth stock, with historical earnings growth rates ranging from 15% to 40% and even higher. I ask that you keep in mind this is a historical analysis that illustrates and proves the power of above-average earnings growth over time. And as you'll see, each of these super growth stocks has generated shareholder returns that are so far in advance of the ordinary stock as to not even relate. Frankly, I would add that I don't expect any of these companies to be capable of continuing to grow at their historical levels. On the other hand, based on consensus forward earnings estimates, each of these companies are expected to continue to grow future earnings at significantly above average rates. I'm going to present these super fast growth stocks through the lens of our fast graph research tool. I'll start with the lowest earnings growth rates and then progressively move up to higher and higher earnings growth rates. My last example will contain the champion growth stock of the group, based at least on historical compound earnings growth. Now, I also want to point out I chose historical time frames for two primary reasons. One, I wanted to review companies that met our definition of above average growth for at least 5 years running, and I did not include estimates in that data. Two, I wanted to examine a time frame that was long enough to illustrate the enormous compounding power of very fast earnings growth. Now let's start with my first example, which is just above 15%, which is Global Payments Inc. And what I've got on the graph here is a picture of the company's earnings per share starting out at the beginning of 2004 all the way out to forecast growth of 2026. Okay, the growth rate over this time frame being measured here is 16.92%. In essence, is the slope of this orange line. So using the PE ratio equals growth rate formula, we clearly draw this orange line at a PE ratio of 16.92. It's above the 15 PE ratio that we use with slower growing companies like I covered in parts 1 and part 2. But this is where the threshold really starts, when you get growth above 15%. Now, when I bring weekly closing stock prices into the graph, you can see that stock prices clearly track earnings. And there are periods of high valuation and also periods of low valuation from time to time. But the general movement of the stock price goes where the company's earnings went. Now, if I measure the performance of this when starting on the first day here and move it up to where fair value still existed, I want you to notice that I get a 15.31% growth or capital appreciation, which correlates very closely to the 16.92. But note that I paid a 27 almost PE ratio, and right now the blended PE is only 12. So the point is, I've still participated in the growth of this company, but it did turn $10,000 into $126,000 over that time frame, just by growing at 16.92%, even though I technically overpaid for the stock in the beginning. And that's one thing I want to interject maybe several times throughout this video. With very fast growth stocks like this, you can overpay for them and still make a great deal of money. Now, from a forecasting point of view, global payments is still expected to grow at about 13% a year, although slightly below my 15% threshold. That's still very, very fast growth compared to the average company. My next example is Decker's Outdoor. And let me take price off of here real quickly and point out that earnings growth here has averaged over 28.66%, including the estimate data, which is a little bit lower than that. But my point is, when I put stock price on the graph, I want you to note that the stock price, again, tracked earnings and goes up at approximately the same rate of change of earnings. But I also want you to note that the stock's a little overvalued here. So when I actually go into our performance graph now, I would expect to see the growth rate of return actually be higher than the earnings growth rate, and I get that. Here we've got a 37.05% annualized rate of return. And again, there's no dividends with this company. This is a pure growth stock. And you compare that to the 7.94% growth of the S&P, and even add in dividends, you still only get 8.7. So what you did here, you made significantly more money by investing in this growth stock than you would have in the average company. And another way to calculate, I can calculate it by using our calculator here in Fast Graphs. And so what you see here, I'm using a slightly different time frame here, but I turned $10,000 into $6,959,000 compared to a much lower number in the S&P 500. The power of compounding and the power of high, fast-growing companies is really extraordinary. The next example is Broadcom. Now, this company has grown at over 30% a year during this time frame. But interestingly, and this is one of the tricky things about valuation, remember, investing is never perfect. The market has historically wanted to price this at a much lower PE of 15. Okay, that could be for a lot of reasons for that. But the point is, even given that, I did want you to notice that it came back into alignment with a PE of 30. Right now, the PE is 30.55. So had you bought this stock back in the beginning here, let's look at performance. A 31% earnings grower, if I go into my performance report, has generated 39.5% growth compared to 13 in the S&P. Once again, that created a total growth of 1,210,000 versus 63,000 in the S&P 500. So the growth rate here is extraordinary. Again, I'll calculate it here so you can see the numbers more clearly. $10,000 invested would have grown to $948,000 from the period November 6th to April 1st. In the performance report, I used a slightly different time frame, but you can see the mass difference. Instead of 60,000, I got 948,000 if I bought and held Broadcom, which, by the way, brings me to another strategic important thing about growth stocks, which I'll cover again here in a second, and that is, even though you can't overpay for growth stocks, you do have to hold them for the long run. And so let me use my fourth example here, Netflix. As you can see, Netflix has grown earnings over this time frame here at over 50% a year. But if I'd have bought that at the beginning of this period on January 1st, 2016, I'd have paid 393 times earnings, significantly higher than the P equals 50 if I was using the pure PE equals growth rate formula. But notwithstanding that, if I'd have held it through today, I'd have averaged over 23% a year. But I do want to make a couple of points. Again, you can't overpay for a true growth stock if the company gives you the earnings because of the power of compounding, as I shared earlier in this video. But the other point I want to make is look at the roller coaster ride you have to go through. And when this stock did have a weak year in 2022, where earnings fell 11%, the stock was trading at a very high multiple in the 60s and became vulnerable, and we had this massive drawdown where the stock price fell over 70%. Now, as long as you didn't panic and held on to the stock, it would eventually recover and give you that 23% annual rate of return that I talked about earlier, turning $10,000 into $53,000, or we'll call that a five-bagger. But I also want you to, again, notice the importance of valuation. Had you bought it when it bottomed out here, and that's about as close to the perfect bottom as you can, over the next couple of years, you'd have earned over 100% a year annualized and more than tripled your money in a very short period of time because earnings started to resurge, and again, the stock price got ahead of the earnings growth. Now, for my last example, I'm going to show Nvidia. And Nvidia is a stock that's obviously getting a big run because of artificial intelligence, but it also has grown at over 50% a year. And if I look at performance, again, a $10,000 investment, the rate of return would have been almost 68% per annum over that period of time versus only 12.7% in the market. This turns into $1,700,000 versus $33,000 in the S&P 500. I think that's so very important for you to understand that the growth here is what really generated the high rates of return. In summary and conclusion, I hope that this primer on valuing super fast growing companies provided insights on how the market can capitalize such enormous growth. I mean, it always makes sense, but I feel it's valuable to be able to graphically see how the market values fundamentals. It's always not logical or even fair, but if you look hard enough, there usually is some logic that you can discover when examining high growth stocks. The important thing to remember is that statistics and stock price alone do not adequately tell the whole story, at least in my opinion. Although valuation matters, and it matters a lot, growth of earnings, in other words, growth in the business, also matters a great deal. So when you're dealing with high growth stocks, you're really looking for that. Now, it's been very, very difficult for me to find, based on history, over the last couple of decades. Companies just aren't growing that fast. But now with the outbreak of artificial intelligence, if you will, there's starting to be a lot of examples where that might be opportunities. Nvidia is one classic example where its earnings have exploded and so has its stock price, thanks to artificial intelligence. Perhaps in the small and mid-cap arena is where you're going to find those companies growing in the future. And I want to make that point very clear. It's the future that matters. And so what you want to look for to get those 10 baggers, 20 baggers, 100 baggers that even Peter Lynch liked to talk about, you're going to have to look for forecast growth over 30% a year or over 15% a year. And the higher, the better. But even a 12 or 15% grower over a lifetime can generate an extraordinary level of wealth for you. But again, growth stocks are tricky. They're higher risk. They tend to trade at much higher multiples, which exacerbates the risk. So be careful out there. It's hard to find that kind of growth that can sustain itself over a long period of time. Anyway, I hope you enjoyed this video. This is Chuck Carnevale, a.k.a. Mr. Valuation. If you liked it, give me a like, share the video with others if you think it'll help them. In fact, share this whole series. Also subscribe to our YouTube channel, but most importantly, subscribe to Fast Graphs. Fast Graphs, the value investor's best friend, in my opinion. Thanks for watching.